High-risk private market investments are now showing up in more 401k plans. Another big 401k provider called Empower, who oversees $1.8 trillion in 401k assets for about 19 million people, has decided it will start allowing private credit, equity, and real estate in some of the accounts they administer later this year. I think this is a terrible idea for investors. I have seen the back end of these private deals, and many times investors have made no money from them and can only get out a little bit of their money at a time, while they are still suffering from low returns and high fees. No surprise, Wall Street loves these because private market investments have those high fees, which range anywhere from 1 to 2% of the portfolio balance on an annual basis. One way they are trying to sneak in the private market funds is with a 10% allocation in the popular target date funds. This is pretty sneaky in my opinion, because you may be thinking you're getting a pretty conservative stock and bond fund that becomes more conservative as you get older. But with a 10% allocation in these private assets, I believe it will increase the fund's risk and lower the returns going forward. As always, the bankers on Wall Street only care about generating more fees and don't care if investors lose money, as long as they bring in their billions of dollars in profits. If you see these in your 401k options, cross them off the list and stick to the traditional long-term investments that have worked for so many years now. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.